Hello and welcome to Investing Confidential, the Harvard issue. Well, isn't it interesting that you've got the President of the United States attacking a university that really nobody likes except graduates of Harvard. And what's interesting about this, and I'll disclose and I'll show you what I mean later, is that this is a canary in the coal mine, and Harvard. If Harvard goes down, I'm not saying Harvard's going to go bankrupt, but Harvard's got major financial problems, which I'm going to talk about. And if Harvard goes down, it's going to be that the old game with the straw breaking the camel's back. It's going to cascade in uncovering a lot of scam, a lot of abuse, a lot of Wall Street shenanigans that people are just going to be shocked. So before they get shocked, I'm going to shock you and tell you from an insider standpoint what's happening at Harvard and why Wall Street is shaking in their boots and why the attack against Trump and the administration is going to be never ending, because the powers that be, meaning Wall Street, politics, cannot allow Harvard to crumble, because as Harvard goes, so will Wall Street. And I'll show you how they're interconnected, and the leverage that there is in the system is shocking, very shocking. But again, first, I have to go back again. We're almost at 37 trillion, 36.9. We'll be in 37 trillion within a few days. This is not ending. This budget situation. As I spoke when the tariffs were going off, don't pay attention to tariffs. It's all about the budget. These budget issues, I'll repeat again, have taken down the government of Korea, Germany, UK, France is in trouble. All the big problems that have happened in the world in terms of upheaval in governments has been due to budgets. And we're headed for a major crisis right now. In the U.S., we've already got a downgrade. Another one's coming. The Senate is not going to be able to solve this issue, but they will do something. But in the end, it's not going to address this. So the budget deficit will rise. In the budget, it's saying to rise to $3 trillion in 10 years. I mean, this is insanity, complete insanity. So nobody's addressing. But guess what? This all links. You're going to see links to Harvard. You're going to see links. This is all interconnected. The whole Wall Street machine is interconnected with this. So let's start from the beginning. All of a sudden, not all of a sudden, but Trump started to push back against universities. Columbia was the first one. Columbia wilted like a wet suit, like a wet noodle, and they're complying now with the administration. They have no choice. They're a complete mess. And so Trump turned his machine against Harvard. Why Harvard? Well, interesting enough, UPenn is Trump's alma mater. UPenn, like Harvard, has probably the same amount of foreign students as Harvard. And I'm going to get into why they have this number of foreign students. You're not going to like what I'm going to have to say, but I'm going to tell you the truth about what has happened. But at the end of the day, if you're a Penn grad, you're a Columbia grad, Princeton, Yale, nobody likes Harvard. Nobody. So Harvard's an easy villain to go after. And I'm going to talk a little bit about Harvard and why their $50 billion endowment fund is meaningless. But what's happening today at Harvard is the whole, and this is bad, okay, this is why things could really get bad, is that the whole Harvard community is now, professors, students, everyone is united to fight against the Trump administration. And this is the worst case scenario because the Trump administration will not back down. And now it sounds like the university is not going to back down. And if the university doesn't back down, then you're going to see major shit happening. Excuse my French. So let's look at the endowments. We talked about Harvard, 50 billion. University of Texas. You got Yale, Stanford, Princeton, MIT. You could throw Columbia, all the big Ivies, Michigan, etc. They got massive endowment funds. Massive endowment funds. But unfortunately, and I'm going to describe this a little later, these endowment funds are not usable. They're illiquid for most of the cases. So I'm going to go back to this a second, but let's go into the origins of why these endowment funds are right now not an answer for the universities. They've been accessing government funds, taxpayer funds, for a very long time, especially the last 10 years, and there's a reason why. And there's also same reason is a reason why there's, for most of these schools, 40% of the students are foreign, and there's a reason for that. So let's go to the origins of, and it all comes back to the endowment funds. So, excuse me, as you can see here, we have to go back 20 years. Okay, this is end of 2024. Well, let's go back 20 years, maybe 25 years, when most of these endowment funds had about 80 to 90% of their assets in stocks and bonds. Very little alternatives, mainly stocks and bonds. And they were volatile, right? Stocks and bonds are very volatile. And at some point, the endowments started to understand, and with Wall Street, that this volatility is not good, right? Because because they have to publish their returns all the time, and the volatility is not good for anybody. And pension funds are in the same boat. And they said, okay, you know what? We're going to start allocating to alternatives, private equity, venture capital, hedge funds, etc. Why? Because especially with private equity and venture capital, there's no mark to market. Mark to market basically means you don't know what it's worth. With equities, you know what it's worth every minute, every day, every week, every month, every quarter. So you got to live with that volatility. But with private equity, venture capital, all these other things, there's no liquid, there's no mark to market. And historically, private equity was amazing, because when private equity was private equity in the 70s, 80s, and early 90s, it was truly where smart dudes would go in, analyze companies, especially companies that were in trouble, right? That was the main companies that were underperforming or in trouble. They would take over these companies, streamline, put technology in, take them public, and everyone made a fortune. The returns were off the charts. And again, they were buying companies that were in distress or were spun off or were underperforming. And this is with their targets. Okay, that has changed dramatically because of the amount of money, which I'll go into a little bit. But that's the origin of why. And then you had VC funds, and again, venture capital, Apple, all the 70s, 80s, all these amazing companies, and they just proliferated in terms of amount of funds. And again, the pension funds and the endowments piled billions of dollars into these funds because there's no mark to market. They could show whatever return they wanted to show, and that's basically what happened. So if you look at the performance of these endowment funds, they're phenomenal. But the problem is that some of these guys got a little too cute. And the way it works with private equity and venture capital is, let's say you commit $1 billion into a particular fund. You don't put up the $1 billion, you put up, 25%, $250 million, and you wait. And every time there's a call, meaning that they're making a transaction, they go back to you and say, hey, all right, you need to put in $100 million, and okay, and you put $100 million in. And that's how it works, the calls. So you don't put up the whole money. So somebody figured out at these endowments, hey, instead of investing $1 billion, I can invest $3 billion because I only have to put up 25%. I put up $750 million. And I got $3 billion in exposure. And then when the calls come, I got my fixed income. I could just pay the calls. And then I've got triple the exposure without telling anybody. And that's what's happened. I don't care. They can deny it. Harvard, Yale, Columbia, Princeton, University of Texas, they piled into these partnerships, these big funds. They leveraged themselves, meaning instead of allocating $1 billion, they allocated $3 billion. And now they had these calls. And for a while, it worked great, right? The stock markets were going up. Fixed income was paying 7 or 8%. And rates kept going down, so they kept making profits. And every time the PE or the VC guys would come and say, hey, we need 100 million. We need 200 million. Yeah, no problem. Well, as like everything else, the chickens have come to roost because we went to zero interest rates. And at zero interest rates, and then so much money was going into these funds, private equity and venture capital funds, that they couldn't find enough deals, distressed deals. So they started doing crazy stuff. They started buying healthy companies, thinking they were geniuses. And what they did with these healthy companies is another disgrace. I could probably make another video of. So whether it's iHeartRadio, Bed Bath & Beyond, Hertz, Avis, they took over healthy companies. And the model was you take a company, you borrow against that company, you pay yourself a dividend, you sell the bonds to BlackRock, Fidelity, because they don't care. And then you took the company public a year later, you got out, and now you're out. And the company's saddled with debt, and most of them, a lot of these big companies, when you see big companies that you know, like, wow, how'd that company go bankrupt? Most likely, if you dug in, is because private equity took it over and destroyed it. iHeartRadio is a perfect example. Took over the biggest radio company, biggest podcast, loaded with almost $5 billion in debt. Now the company's reeling. Even though the company's doing well, they just got too much debt. Again, private equity. So this private equity is toxic. Now, so much money came to private equity, they have too much money now. Way too much money. And as I said before, when we look at the whole situation with the endowments, they got bigger and bigger. Why? Because their private equity investments never went down. So they just compounded. And they told their donors, hey, give us more money. We can do, yeah, the donors gave more money. People got wealthier and, But something happened on the way. As we look here, this is a financial statement of Columbia Endowment about their returns. And their returns start to become subpar. So if you look at Columbia here, university trailing 5 and 10-year returns 8.5% to 7.4%. The bulk of that $15 billion is in alternatives. And even though it was in alternatives, again, illiquid stuff, which historically was returning 20+%. Now you have these endowments that can't even beat the S&P 500 over the last 5 or 10 years. Not even close. The S&P 500, which basically what these endowments could, they could have bought SPY, put $5 billion, $10 billion, $30 billion, and just massively outperform. But no, they're too smart for that. They invested in alternatives, and these alternatives have been stinko. The average VC fund over the last 10 years is not even close to outperforming the S&P 500, the most liquid instrument there is. And you have even pension funds having the same problem as the endowments. Again, private equity, venture capital. This is a nightmare. These funds they put billions of dollars into these private equity portfolios, and the private equity funds are underperforming, but they still have calls. They're still asking for more money. But on paper, right? Look at this. This is very interesting. On paper, these pension funds are showing that they're in surplus, meaning they have more money to pay out than people to pay out to. On paper. Historically, it's been the opposite. But this has been a combination of the rise of stocks and bonds, the most amazing asset move we've ever seen, especially since COVID, right? This is all because of COVID. Why it's all going to reverse, but this is all because of COVID. And so on paper, these guys are showing big returns, but are those really big returns? Can they get those big returns? Now, the reality is private equity, I'm going to get back to Harvard in a second here, but private equity has a little problem. They have too much cash and they can't exit anything. They can't sell any of the positions they have because they, instead of buying distressed or underperforming, they bought performing assets, and they found that, hey, you're better off doing that in the public markets, not in the private markets. They're not buying Apple. They're buying some private company, and they're loading it with debt, and now they have problems. And their fees are compressing because of that. So you have here today, this is basically cash. These private equity funds have cash, but they're still asking for the money, the calls, because if they don't get those calls, they don't get their fees. So the private equity funds still loaded with cash. They can't find stuff to buy. Stock markets are all-time high. Private companies are selling at all-time highs. They're not buying anything. They can't find anything, or if they do, it's a nightmare. And it's a problem for the whole industry. So what's private equity doing now? Well, what they're trying to do here, as I said before, they're liquidating, meaning they're selling bonds, massive debt into their company, and paying out dividends to themselves, decreasing the amount of equity they have. And so they don't care. They don't care. So it's a mess. And the only thing that's helped these guys is that the economy's held up. And because they're loaded with cash, because their returns are low, they can't raise any money now. So they're dependent on the calls from the endowments and the universities. And here I'm going to get back to Harvard now in a few seconds. And Wall Street can't help them either. Because as you can see here, we're right now we have the smallest IPO, the worst capital markets environment in history. In history. No IPOs. There's no investor appetite for this junk. So because of all this, you got places like Harvard that had this exposure to private equity. And it's not only private equity. It's not only private equity, it's venture capital. Okay, all these funds, and venture capital is the same thing as the private equity. Endowments, they go into the fund, they're supposed to fund tech startups, supposed to go public. That's not working. That's not working. Because these venture capital funds, they're doing worse than the PE funds. Doing worse. So it's a scam. So let's get back to Harvard now before I get into the thing that's going to break the camel's back. So going back to Harvard, you've got a system where they're dependent on the government for their liquidity, grants, etc. And now that spigot's been cut off. And you would think that they could do something with their endowment, right? $55 billion. No, they can't, because most of it's locked up in alternative investments, which they can't get out of. And so what is Harvard doing when they get a call? What is Columbia doing with it? What is Penn? What is University of Texas? They're borrowing money. They're borrowing billions from banks, alternative lenders, to pay these calls. So these funds now are double levered. They're over levered on the funds themselves. Then they're borrowing money to pay the calls that they're getting from the PE funds and the VC funds. I mean, if this was mark to market, Harvard endowment would be bust, or would be down 50% from its peak, and they know it. They can't take a markdown. So they tell is like a spider web. It goes, so they tell the private equity funds, we can't have you, you can't underperform. So make sure that all your companies stay afloat. You can't take a markdown. So their companies keep borrowing. On the VC side, the companies can't raise money, so they're borrowing money. Because if you're a startup and you were worth $1 billion 2 years ago, and you need money and you have to take a down round to, let's say, 700 million valuation, that's a 30% drop that fund has to hit. So these funds can't take hits because Harvard can't afford to take a hit on their portfolio because it's illiquid, and they're borrowing loads of billions of dollars to keep their, and it's affecting university. It's affecting their university. And it goes back to this whole idea of a united university. And now I'm going to get into something very, very, very controversial. And I'm sorry, but this is the reality. So Trump's now on this whole foreign student thing. And it is shocking that 40% of the student body for these big universities are non-U.S. students. Nothing wrong with that, but it's too big a percentage. But there's a reason why that these universities have large percentage of foreign students. The foreign students pay full boat. Harvard costs $70,000 a year. Princeton, 60. Columbia is 70. It doesn't matter. And these foreign students pay full boat. Why do they need people to pay full boat? Well, it goes back, again, years ago, a decade ago, 15 years ago. Now, I'm not going to tell you which one of these universities, but I went to one of these Ivy League universities, and I could tell you back when I went, which was a long time ago, universities were mostly white and a large percentage Jewish, probably 20-25% Jewish. Most of these big elite universities. It's the reality. It's not the reality today. Universities today are 25% white, maybe 5-6% Jewish, and then diverse, as they want to call it. And so when these universities became, and I guess the only word to say is woke, and they decided they had to bring in non-white students, let's just put it that way, non-white students, especially minority students, Americans. These students did not have the grades. Most of them didn't have the grades to get in, but even more importantly, they didn't have the money. So Harvard Endowment and other sources started letting these students in large numbers, and they gave them grants and scholarships because they couldn't pay. And they had to they had to increase the diversity. So when you increase diversity, what happens? Unfortunately, you got to pay for that diversity. So the more diverse that Harvard's gotten, the more diverse Columbia's gotten, NYU, Penn, it's all of them, the more they desperately needed full-paying students to offset. Now, there's plenty of rich Americans that could afford to go to Harvard, but they don't want those students. They had to increase the diversity. So what'd they do? Take in foreign students, especially from Asia. That increases your diversity, but at the end of the day, it was all about money. This has nothing to do with black, white, yellow diversity. It has to have to do with money. They need to check boxes, but they need to pay. So now, going back to Harvard, you've got a student body of 40% foreigners, or 30 to 40%, but it doesn't. They're all the same. And they're full-paying students. So when the Trump administration now, going back to, says, sorry, no more foreign students, use your endowment, the endowment's illiquid. The endowment is dry. $50 billion on paper. It's not worth $50 billion on paper. The endowment is dry. So there's a problem. There's a huge problem. And I think the Trump administration knows that, and Harvard has got serious issues. And if Harvard were forced to sell one of their positions in private equity, one of their partnerships, they'd probably have to take a massive hit, and it would hurt their performance. And then another hit, and do you see what I'm talking about? This would cause a major and I haven't even gone into what the real major problem is today. And it's not private equity, because private equity is, like I said, underperforming. It's private credit. And private credit is another one of these illiquid instruments that the endowments and the pension funds invest in. At basically it's just private junk bonds. So it basically is massive amounts of junk bonds from small companies, larger, doesn't matter. Private credit, private companies. You can't even do due diligence on private companies. And that's all. And so this whole private credit thing, again, because rates went to zero, because Wall Street, Ben Bernanke, I don't want to get into it, but it's all a scam. They brought rates to zero and made private credit. Don't worry about the risk. There's no risk in private credit. And so that's the next thing. Private credit supposedly pays interest. No, I'm going to tell you why. That's not a... So, and what's happening now, private credit has gotten so big because people don't want to put any money in private equity anymore. I don't want to put any money in venture capital because you don't get paid for 8, 10 years. They want the private credit. And that thing's come to a head. And we could see some anecdotal evidence. Okay? Collateralized obligations. This market has become illiquid. Illiquid. Wall Street's holding it together with Band-Aids. This is private credit. You got signs that you can't raise money anymore. It's too big. It's gotten too big for itself. You can't. Nobody wants to put any more money in. It's gotten so big, so they can't raise money. And a real Ponzi scheme ends when you can't raise money, when you can't use the money to pay the other guy, and it's just one big Ponzi scheme. It's a professional Ponzi scheme, but it's a Ponzi scheme. So guess what? And here's where you better open your eyes. Guess what? Guess who's gonna pay for it? You. Okay, our friend Larry Fink. He wants you. He wants to take private credit and slam it into the public, to individuals at wealth management companies. Regular Americans need private assets too, says Larry Fink. This guy's a joke. He's not a joke. He's a smart dude, but he's evil. Okay, this is evil. He's saying that because all his buddies are telling him it's a bubble. It's bursting at the seams. We need to unload this crap. His buddy, and so who's gonna buy it? You. Maybe not after watching this video, but you. And the same with Apollo. It's not a bubble. Why is Apollo saying that? Well, they've joined forces with State Street, and they're doing ETFs, private credit ETFs. Private credit ETFs. And look, I mean, they're even like, it's funny, they're even telling you that private equity is a warning, it's evil, and you should, and what they're telling you basically is go into private credit. And this is really just horrible. It's absolutely horrible. So, bottom line is, Harvard is the key to everything. If Harvard has to sell down underperforming assets to pay off some of these loans, that the banks say, hey, we're not giving you more money. And by the way, if you don't meet one of those calls, they take all your equity. Harvard's not about to lose $1 billion in cash. So they may have to sell some of their positions at big losses, and that's going to create a problem. And again, they can't meet their obligations unless they have foreign students. So what'll happen if they have to get rid of foreign students? Well, they're going to have to bring in American students who could pay. So the result of that will be Harvard will lose their diversity pledge. Most of these universities will go back to the way they were, which was 80% white, male or female, don't matter. But that's the reality. You may not like what I'm telling you, but this is the reality. This is what they're not telling you. And I'm all going to wrap this up in one way and show you one thing that I saw today, which just tells you everything you want to hear. Hampton vacancies. We discussed the real estate market, right? So remember, financial assets are bonds, stocks, and real estate. Well, the Hamptons is imploding. And who goes to the Hamptons? Wall Streeters, private equity people, venture capital people. Nobody's renting. 5,000 homes available? That's insane. This is Memorial. My God, it's the end of May, beginning of the summer. And nobody is renting. The amount of houses being sold, the actual amount is very low as well. There are some houses being sold, but they're very low. A lot of houses for sale, a lot of vacancies. The rich, the elite, are telling you that something's hitting the fan right now. And the canary in the coal mine is Harvard. Tariffs, the budget, very interesting stuff, the budget especially, but watch Harvard. Watch Harvard. Harvard's not going anywhere. It's going to be around for the next another 300 years, over how old it is. But if they decide to do what they almost have to do to meet these calls they have, then you're going to see dominoes start to fall. The first thing will be unwound will be private credit. Then you're going to see the big PE firms, and they have a lot of cash, so they're not going to, but you're going to see those returns start to plummet. People are going to start to pull their money out. And the same with venture capital. That's already popped. So this Harvard thing is a lot more. It's like you're going out there and you see something that looks little. It's okay. It's not going to harm anybody. But underneath is huge. That's Harvard. The underlying risks that all these endowments, all the pension funds have with these illiquid investments is coming back to roost. So if your wealth manager tells you that it's a great time to do private credit, private equity, hey, you got all these great instruments, don't just say no, run away from this stuff. This stuff is toxic, and it's beginning to unravel. So as always, if you're an investor, stay with the liquidity. Non-U.S. assets are significantly outperforming U.S. assets, even with this big move we've had, okay, with the U.S. As always, especially if you're invested in alternative assets, be careful out there.